Peter Rose, Longwood Currency Trading. Good morning. It's well, it's actually Father's Day in the United States here. Sunday the 20th. Tomorrow is the first day of summer, so I won't be publishing this video for probably about a week. But I would like to chat about the fallacy of setting profit targets in your Forex trading. I think it's going to be a little surprising for those of you who don't have a lot of general life experience or any experience in trading, for sure, because setting a profit target is like setting a goal, right? Well, we all know what goals are, and we all know how to set them. I want to get a classic 1968 Corvette, or I want to get that promotion to senior clerk, or take a vacation to the Maldives, or Birmingham, Indiana, or something. Those are goals. I want to get 20 pips out of this trade. That's a goal. I mean, you just don't arbitrarily say, well, I want to get 20 pips out of the trade, because we all know that the economic activity that goes on behind the scenes in currency trading is a currency Forex market is setting client expectations for the currency level that the broker is going to be able to get for their client, okay? And they have to manipulate that price, not so much that they're manipulating it, they're simply going to different sources that have liquidity, other banks and hedge funds and whatnot. Hey, I've got 400 million yen to sell, and I want to buy dollars, that sort of thing. So these large orders make their marks on the charts, and that's how not only the general traders look at it. I mean, they're not looking at the chart. They're saying, I gotta get my client this level of order, and so they're not conspiring against us, the retail traders. They're just trying to conduct business. But in the conduction of their business, if the orders are large enough, they can't help themselves but leave marks. Call them tracks on the chart. As the Dakota American Indian would say, we are forever known by the tracks that we leave. And that's true a little bit for the currency markets. These patterns that occur represent a campaign or a series of campaigns that are similar. You know, maybe there's 4 different banks that are working on several different clients, all wanting to buy the pound and sell the New Zealand dollar to conduct their business. So they're all going to be kind of moving in lockstep. It's like the waves on an ocean. You get a bunch of little waves to hook up together, right? And you get a big wave. So unlike from a philosophical sense, as the Dakota American Indian would say, that you're forever known by those tracks that you leave, those tracks are valid only for the length of the trading campaign that the brokers are looking to fulfill client orders. They're left on the chart forever, but that doesn't mean that they're necessarily going to continue. But they do indicate where the institutions have found liquidity, or maybe the campaign isn't over. You know, if you had a $7 or $8 or $10 billion order, and that's not out of the magnitude of realism when you're talking about a $6.6 trillion a day market, in 2021. It's been that way for a couple of years at that level. When I started looking at currency markets in 2007, I think it was $3 trillion a day. So it's grown, doubled since 2007. More than doubled, actually. So our profit targets are sort of, well, we found a tremendous amount of liquidity at this particular level, and so that's probably about as far as price will go in this particular run before it runs into some similar activity. And so I'll say that I'm going to get up to that zone, or I'm going to come pretty close to that zone, and so we set the profit target for that. And you'd think that that would be valid, and it is. I'm not, I guess it's kind of tongue-in-cheek that I'm saying that there's a fallacy in setting profit targets. I guess the fallacy rests for those who don't understand what's going on under the sheets and simply are talking about structure like the frickin' Holy Grail. And, well, we're going to set these levels and it's going to go off of here and it's going to go off of there, and hey, maybe it will and maybe it won't. If you're trading long-term and you're basing it on levels, I think you're out of your mind, because what happened 4 months ago has really nothing to do with what you're going to be looking at over the next 4 months. So as a day trader, there's campaigns, transaction campaigns going on all the time. And so some of the larger ones that may be taking place in the currency pair that you're looking at may be an ongoing thing over the course of a couple of days or maybe even a week of trading in and out. And so as a day trader, you can look back a couple of weeks in time and say, well, that's it looks like there's some marks here that may represent some valid zones, and base it on that. The fact that if you take a daily or a weekly chart and plot those support and resistance zones out on a chart, and they seem to respect those levels as time goes out, is the result of the economies wanting to keep their currency within certain boundaries. I mean, if your currency, if the value of your currency is too high, nobody's going to want to buy your stuff. If your currency is too low, you don't have the buying power to buy somebody else's stuff. So, we just came out of a period in the United States here where there was tremendous pressure from the president. I mean, I don't want a weak currency. And then there was another one. I don't want a strong currency. We don't want a strong currency. We want people to buy our stuff. So it's very problematic as to how you're judging these profit zones based on structure when you have to take into context the time frame that you're thinking of trading on. Because in the long run, none of that structure really makes any sense. It's a guidepost. It's like I'm driving down the highway or a road, country road, and there's a stop sign up ahead of me. I stop at that stop sign and then I go ahead. I can't say that, well, I'm going to use that stop sign and the next stop sign and the next one to say every 3 months I'm going to have to stop. 3 miles. Because the one stop sign doesn't have anything to do with the next one, right? It's all to do with the conditions in travel, at that particular area, whether they feel that they need to have a stop there to prevent people from crashing into one another. So the fallacy of setting profit targets is simply this. When you set a profit target, you set a goal. You're setting a target. So mentally, you're saying, I'm going to get out there. I'm good to get out there. But that's like saying, I got a birthday coming up, and when I get to that birthday, I'll be, 88, and that's it. That's as long as I want to go. I'm done. That's my goal, to get to 88. Well, you got a birthday that's out there. It's 88. It's nice to get there, but don't you want to get to 89? Wouldn't it be nice to think that you're going to go to 100? And so trading currencies is the same thing. Look at the nature around you to tell you how to conduct your life. Not only your life, but from a philosophical and emotional standpoint, but also from your trading. To set a goal as a day trader, we're constantly in and out of the markets. We're not setting profit targets. We're identifying areas where we think we might be able to get to based on current resistance and support congestion zones of price action. But aren't we really saying, maybe at that zone I'll pull half of my position off, and we'll see how far the rest of it runs. You can't just come to the conclusion that you're going to do that. You have to understand life. That the profit target that you may arbitrarily set, and maybe not so arbitrarily because it's based on some sort of structure or freaking voodoo song you hear in your head or whatever, but you're hoping the price will go further. So when I trade, I have a trade on now, and my profit target is reasonable, but I've looked beyond that to say this is possible, and it's such a large amount of money if the position goes there that I would be very happy to take that large chunk, because you have to be able to judge what's reasonable to scrape off the table on a win so that you don't get too greedy. Then all of a sudden the greed, which works in your favor in projecting profit targets out beyond where the initial one you set is, well, maybe I can squeeze this for more. That's the greed part. But the closer you get to that far out target, even if it isn't a target, it's just an area, the closer you get to that, the more fearful you have to become, not the more greedy. You act greedy, but you have to be hyper alert. The whole concept of my trading from the start has been to be very, very fearful at trade entry and just put a short stop on there and just get out because I'm wrong. But when I have a position on, let it run. Don't set the profit target. Have an idea of where it might get to, but be very, 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 very greedy all the way up. And as I traded more mini lots, or now I'm in a position trading multiple full lots, I can stage in as that price goes, and stage in beyond the profit target, but be hyper alert to the fact that may turn on you at any moment. But that's okay. I talked about this in a previous video about your price goes to, let's say your price was 60, and it gets to 60, and you go, oh, it's going to go a little bit further. It's going to go great. It's going to go to 80. And so it goes up to 80, and you're going, let's push it. And then it starts to weaken a little bit, and it starts to come down. Oh, I don't want to lose that. I don't want to lose that money. And so you hold on to it, and it just keeps on going and going and going down. And you're greedy when you should be fearful. And yet, at the same time, if you don't understand that process, you would say, well, it went to 80, but it came down and I got out at 60, which was my original profit target. But I lost 20 pips. But you didn't lose 20 pips because you didn't have them. You didn't close the trade. You got 60. You have to look at it. I got 60. It pushed to 80. I could have got out. I didn't know how much further it was going to go. But it started to weaken, and it came back to 20 pips. And maybe it's not going to find support at that 60 pip profit level and turn around and go back up to the 80. I'm just out. And I'm happy to get what I got. But I tried for the 80. That's the profit target. You got to try for the most that you can possibly get, because if you slip up one time and don't take a quick loss, that loss will magnify itself hugely. And regardless of whether you're a day trader or whether you're a long-term trader, a big loss is proportional to the time frame that you're on. A big loss for a day trader might be a couple of hundred pips. Well, it might be 400 or 500 pips loss for a long-term trader. You know, the Turtles, Richard Dennis's group, would go out and take sometimes as much as a 4-hour stop. The price has got to come back 4 hour before they get out. That's an enormous loss. But if it didn't come back and it kept going another 4 hour, and then it came back 4 hour, I mean, the money that they were able to make was great. Now, that was all trend-based stuff, and the markets, even Richard Dennis has said, the markets have changed, and that process isn't as valid as it was 30 years ago or whenever it was that he was trading. But the principle is still the same. You stay greedy all the way until you have identified something that you should be fearful about. So don't set these hard profit targets. Set a hard stop for your entry, but don't set a hard profit target. A profit target is just a suggestion. If you get it into your head that you have a profit target, that's your goal, you'll probably be very successful at achieving that goal. But you're leaving a lot of money on the table. That's why poker players go all in. Because they're not, if there's a potential to take everything on the table and everybody's money, they want to do that. They don't just want to settle for the. When you play the game, currency trading or poker, whatever money you make for the risk involved is well earned. And so, if you're going to be taking risk, don't limit your profit by setting a freaking profit target. It's a suggestion. Don't put a limit by to get out or sell to get out of your long position. Because you're cutting yourself short. I just had a stock that I've been sitting on for years, and I said, well, if it gets to here, that's where I really want to get out. And it went, 30% down and 50% back up, and it's been fluctuating over the period of time. And finally, I said, let's just get out. And so I made a little bit of money. But 2 weeks later, of course, it went $5.50 higher in a couple of weeks. I could have doubled the profit that I had, because that was where my profit target was. In fact, it went beyond where I had originally set that profit target. I don't regret getting out, because the markets were in a lot of turmoil, and I just said, I don't want to deal with this because I don't understand stocks. I hate them. I just let's get out. Currencies I understand, and I'll make a lot of money with that, as I've identified some of the issues that are causing me, well, the issues from my 40 years as a real estate investor. You can look at real estate, you can say, hey, over the long run, it's going to appreciate at 6.5%, 7%, 8%, whatever is in your head. And so I'll hold this for 20 years. And in 20 years, I'm going to retire, and you do a future value of a current income stream, and you project out what that building will be worth. You say, hey, when it gets to that point, I'm done. That's what I did. You know? But during the course of the career, I lost $1 million twice in my life due to economic collapse, which means I made $1 million, you know. But you don't just cash out at that point. You hold, because you're looking for the long game, not the short game. And so it's not any different in currency trading. It's just that the timing is a little different, and your risk has to be proportionalized to the types of gains that you're looking at. I mean, in real estate, for example, I took a building I bought for $73,000 and I sold it a few years ago for $600,000. That's the long game. That's what you're looking for. But when you're doing currency trading in a day trading type environment where you're going to be out at the end of the day, I mean, are you going to get 300 pips in a day? It's probably not. You know, you might get 20 pips that day. And I'm not talking about having multiple lots on and counting a 5 pip gain. A 5 pips actual gain is 20 pips gain because you had multiple lots. I'm talking about ticks on the chart. I mean, sometimes you could get 30 or 40 pips in a day, but reasonably, what could you expect in a day? I mean, you can make a really good living if you can make 8 or 10 pips a day. No kidding. But, you know, let's say you're really active and you're really good, 20 pips a day, you could get that. Well, that's the maximum. I mean, the people that are like I am, who are good traders, but, you know, we're not George Soros here, you're not going to want to try to push the day for 40 pips. You know, I know that if I get 10 pips, I'm really good. I'm going to be very, very fearful after that about losing anything. And if conditions aren't just absolutely excellent, I'm just going to shut the trading platform down and I'm going to call it a day. I don't have unreasonable profit target goals as strict targets. I have unreasonable profit target goals as goals. But as soon as the real initial reasonable profit target is reached, I'm going to take a little bit off, maybe, and I'm going to see how far that thing will run. But I'm going to be very, very fearful from that point on. So that's the fallacy of profit targets in currency trading. I hope that was helpful for you. Let me know, and don't send comments. I don't need those. You know, if you want to chat about this stuff, throw me an email and watch more of my videos. And I thank those that have subscribed to the channel. I appreciate that. I don't have many subscribers, and there's a reason for that. And I appreciate those of you who have subscribed, because I know you're loyal and you're interested in what I have to say. I'd rather have 50 or 100 really good subscribers that I can engage with, as opposed to 10,000 or 1 million that are just leaving trash comments and really don't give a crap about what I'm trying to say. Peter Rose, have a great day and have a great trading day.